Hello and welcome back to this month's Insight series. Today I sit down with our senior portfolio manager Tyler Ellegard. Tyler, thank you for joining me today.
Thanks for having me back.
You have brought a very interesting topic, one that more and more investors are talking about, that gets more in the forefront of our minds, alternative investments.
Yep.
So we'll talk about the benefits, the disadvantages, and why it could be beneficial to add that to a portfolio.
Absolutely.
So I'm looking forward to that conversation.
Yeah.
Before we start, I, as always, start us off with the year-to-date asset class returns, just so we see where markets are headed year-to-date, and we just closed out the first half year of 2026. And when we look at the right side column, US large cap stocks up double-digit. That's wonderful,
Another good
right?
year. Yeah.
Yep, absolutely. US small cap stocks outperforming by a wide margin. International developed up, as well as emerging markets and bonds. Gold is having a little struggles now, and Bitcoin is also still underperforming as well. So Tyler, when we jump into today's discussion, alternative investments. So can you talk a little bit about what this entails? Because there's a lot of things that are considered alternative investments. Sometimes it can be a little bit confusing, the whole world of alternatives, and why they also are different from traditional assets like stocks and bonds and cash holdings, what we usually see in a portfolio.
Yeah, I mean, alternative is a very, very broad term. So I think what we'll focus on today is more the private side of it. But typically, like you said, traditional investments are your stocks, bonds, cash, ETFs, mutual funds, things like that that are publicly traded that you can buy on an exchange in a Schwab account. Private investments are more so the private equity companies that do not trade publicly, so you have to have a fund that invests in them. Or you have private credit, which is investing in the debt of private or public companies, which I imagine we'll touch on here in a little bit. Think about collectibles. You can't just openly go and buy collectibles. That could be I know one that comes to mind is NFTs, but a lot of times it's watches, art.
Vintage cars.
Yes, exactly. So things like that. So things outside of what you would normally buy in like your Schwab account, your brokerage account, anything like that.
And also a very important distinction is traditional investments, like you say, are publicly traded, and alternatives are not always, sometimes, because when we think about cryptocurrency and gold, for example, that's also considered alternatives, but then can be publicly traded, but more the private equity, private real estate, that is not.
Which we'll focus on today more so than the other aspect of it.
And Tyler, always, often the discussion always arises, what is the difference actually between private equity and private credit? Because they have some things in common, but are very distinct from each other.
Yes.
So can you touch a little bit of what the difference actually is?
Yes. So I mean, if you think about private equity is investing in a company, just like you would invest in shares of Amazon, for example. You own 3 shares of Amazon, means you own those 3 shares in Amazon stock. So when Amazon's value of their company goes up, you benefit as the investor. Same concept with private equity. You buy into a company that is still private, they're not publicly traded, but you get a certain amount of shares of that company, and when the company does valuation rounds or funding rounds, you get to, that's really where you see the value of your money increase. Now, it doesn't always have to increase, it could go down, but the whole point of private equity is that you get into a company early, that company grows at a pretty rapid pace, eventually they IPO or do an initial public offering.
We have a good example of that.
We have a good example with SpaceX, but that's the exit proposition for a private equity investor, is you get in early, company grows rapidly, you make hopefully a good return on your money, and the company goes public, and then you can sell those shares with a higher value of your principal. Now, the difference between private equity and private credit is, well, and I'll take a step back, is private equity, those companies are truly private. When we talk about private credit, it's a little bit different. Private credit is you just own bonds that are structured in a certain way for a company to give them a loan. Private credit doesn't mean that it has to be a private company that you're loaning money to. It could be a public company. So oftentimes if a public company, whether their debt rating isn't that good, whether they want to structure a deal differently than they could in the public markets, they would go to the private credit type funds and get a loan from them rather than going to the public market. Even though they're publicly traded, you can still own bonds from a publicly traded company in a private credit fund. But then oftentimes you see a lot of companies that don't trade publicly, or their bonds don't trade publicly in these types of private credit funds because they're too small, they're too niche, they can't go to market, different things like that.
Yeah, that is an important distinction between the two. And with everything in investing, there's pros and cons to everything, to every asset class, always. So can you elaborate a little bit on the benefits and potential disadvantages of alternative investments?
Yeah, so one of the main benefits of private investments is typically when you're investing in private equity or private credit, you get an illiquidity, what we call an illiquidity premium. Because you are locking your money up, which is one of the cons, this is illiquid money that you're investing into these companies, knowing that you might not be able to get it out right away. Whereas if you buy Amazon, Apple, Google stock, you know that you can sell it, you can buy it today, sell it tomorrow. Private credit, private equity, not the same. But because of that, you get the illiquidity premium. So your returns tend to be, I'm not going to say always higher, but generally speaking, you could expect a higher return on your private equity or private credit funds or investments because of that. The other side of it is gives you a pretty good diversification across companies and where you're investing, because you're not getting the middle market of America. Yes, you can invest in small caps, you can invest in mid caps, you can invest in large caps. But oftentimes these companies, they're early stage or earlier stage, and it's companies that you're not going to get exposure to, consumers you might not get exposure to with some of these other companies, industries you might not be able to get full exposure to. So it gives you some broader diversification, and also it tends to have lower volatility. Now there's some reasons for that, but generally speaking, you're not seeing the day-to-day fluctuations in the price of these companies because you're letting these companies play out over long periods of time, rather than saying today Amazon's worth this, but tomorrow it's worth this. Whereas with these private companies, today it's worth this, in 1 year it's worth this because they've done X, Y, and Z, right? So you get less volatility in the portfolio.
Yeah. Can you also expand a little bit, because you talked about the illiquidity premium, or that it's not as liquid as public markets. How would an investor get the money back from alternative investments when we think about quarterly redemptions? How would that work? And we heard a lot about that in the news earlier this year.
Yeah, so generally speaking, the idea is that you're going to be putting this money, investing this money into this company or this fund for an extended period of time. The idea is that you don't need the cash readily available, right? This isn't a short-term investment, because these companies, if you think about SpaceX that we just talked about, SpaceX was founded in 2002. They just went public in 2026. So that's 24 years that now investors may not have had their money locked up in SpaceX for those 24 years, but the idea is that you're investing in these companies for long periods of time. So you have to understand that part of it. With these private credit, private equity funds, there are what we call quarterly redemptions, where the fund might have 5% of the fund available in cash for any redemptions that come in. What we've heard about in the news lately is that we're hearing this gating term, where instead of only having 5% of the fund this quarter being redeemed, there's about 10 to 12% of the fund trying to be redeemed. So what the fund does is there's two options. Most of them go with option 2, which I'll get to. But option 1 is the fund has the ability to do first in, first out, where if you're the first person in the line for the redemption, they'll give you your full money out that you're requesting. If you're above that if you're the person that's above that 5%, you get nothing. Option 2, and what most of these funds are doing today, is they'll prorate it. So if you have a 5% cap, but 10% is trying to get out, simple math, 50%, they'll prorate it to 50%. So if you request $100,000 out of the fund, you might only get $50,000. And then next quarter you have to put in a new redemption. So that's what we're hearing about a lot in the news lately. So we'll see how that plays out, but it's always something that as you invest in these funds, you have to understand that that could happen.
Yeah, in the news it's always portrayed to be negative, the gating or these redemptions, but to see it as a safety feature for the investors that are staying in there, it's also to protect investors who are staying in the fund. So it also has a positive side.
Yeah, because the problem is because let's just take private equity. Private equity, it's not a liquid market, right? You invest in company XYZ. If all of a sudden you're forced to try and sell your shares to somebody else in that company, chances are you're going to take a pretty big haircut on what the intrinsic value of that company is, and that's not good for the people trying to get out of the fund. It's also not good for the investors that are staying in the fund.
Yeah, exactly. And Tyler, when we talk about it, alternative or the add of alternative investments to a portfolio can enhance long-term returns. And when we go deep into the financial language, there's something from Henry Markowitz that's called the efficiency frontier, right? To create a portfolio based on one's risk perspective and risk tolerance and what we can expect. And there's an efficient way to do that.
Yep.
Well, now when we look at the left chart here, adding alternatives gives us a little bit better risk-adjusted returns. So can you expand a little bit on what the goal here is and why that is?
Yeah, I mean, plain and simple, the goal is to either take the same level of risk that you currently have and enhance your return, or get the same level of return that you currently have for less risk. That's the whole idea of the efficient frontier. It's the whole idea of adding alternative investments to a portfolio.
And also when we talk about private equity and private credit, when we stay with that and that it can potentially give you more returns over longer periods of time, what can we expect here in private equity versus private credit?
Well, I mean, private equity is really used for growth. It's a growth vehicle because you're investing in these early stage companies. They don't have money to pay you a dividend because they're trying to reinvest all of that money into the company to grow the business. Private credit, you're really looking for the income. So if you're doing a private loan to a company, because that company is coming to you to put specific covenants in, do specialized deals, you're going to demand, also locking the money up for longer periods of time, because it's not trading on the open market, you're going to demand a higher yield or higher coupon rate. So the whole goal of the private credit is to invest in these companies or give them loans that you think are going to be around for the next 5, 10, 15 years, but because they're coming to you specifically, you get a higher yield than you would in a U.S. Treasury or an investment grade bond.
And you just said it, like private equity, more for growth, private credit, more for income. So very distinct use cases based on what your needs or what investors' needs are. And Gradient Investments actually has a great offering since the start of the year of 2026 we call it our private wealth series, in a broad range of alternative investments. So can you touch a little bit of what our Horizon and Income Edge funds are? Yeah,
so Horizon is really the growth-focused private equity, private infrastructure fund. So we'll invest in companies' funds like Apollo, Blackstone, Carlyle, Hamilton Lane, like some of the biggest names in the private equity business. It's not like we're going and sourcing the deals from the companies ourselves. We're using funds of companies that know what they're doing. And we do our own due diligence on the funds themselves. But generally speaking, the Horizon Fund is really for that private asset, private equity, private infrastructure that gives you the growth profile that you would expect out of a private type of fund. And the whole goal is to essentially capture the illiquidity premium of investing in these, not necessarily smaller companies, because SpaceX was private and now they're the 8th largest company, but trying to capture just the pure illiquidity premium that you can generate by investing in these types of companies. The Income Edge is a little bit different. We're focused more so on the private credit, private real estate, to give you that income that you're looking for. So typically, because again, everything is the illiquidity premium. That's what private markets are, obviously for diversification as well, but we're really looking just for the pure income generation in the Income Edge portfolio. Good marketing name, obviously. So again, that's if you're trying to pair it with your traditional fixed income, whether it's our fixed income total return, our designed income portfolio, or absolute yield, you can pair this one with one of those portfolios to give you that, I would say, 7 to 9% yield in a portfolio.
Great. Thank you so much for joining me today, Tyler,
Absolutely.
and kind of shedding a little bit of light of all the alternative investment world out there. I will summarize what we just heard. Alternative investments can be a valuable addition to a portfolio for patient, long-term investors. It can offer the potential to enhance diversification while improving long-term return opportunities in a portfolio. And Gradient Investments Private Wealth Series offers access to a broad array of alternative investments. And last but not least, as always, have a long-term plan, stay diversified, and stay invested. And with that, thank you so much for joining us today, and thank you for your precious time. We will be back next month with another exciting topic of what drives the markets.